Because we missed last week, I'm going to kind of abbreviate things a little bit, really focus mostly on what you need to know for the final. And then I do have your midterms, which I will hand back out here for the class, and we'll go over those just a little bit. But your scores should all be posted now. And let's get going. All right, so we're going to start on page 82. So tonight we're going to start by talking about business organizations and the various different formats that we have available when you're setting up a business. And most of what I want to focus on, I've got summarized here on page 82. And I'll tell you right now, I'm going to get into a lot more detail than I was testing on, just mostly kind of more from a real world standpoint. And again, I'm going to start off by just really focusing on what I want you to know for the final. We do have other classes here at Western where they go into this. One of the classes I teach is how to actually start a business, and we get into a lot more detail in those other classes. So I'm just going to kind of touch on some of the basics at this level of class to make sure that you know what I'm going to focus on for the final. So with that said, actually I'm going to go back a page to 80. All right, so let's talk about what I want you to know absolutely for the final. So first of all, page 80. Fill in the blank question, 100%. What are 4 forms of business organization? So we have sole proprietorships, which I'll abbreviate as SP, general partnerships, or GP, limited liability partnerships, or LLP, limited partnership, LP alone, LLCs, which is limited liability company, C corporations, which are taxable corporations. Then we have S corporations, which are what we call pass-through, and I'll explain that in a minute, or a non-taxable corporation. So I want you to be able to list 4 of these different formats, right? So page 80, and I'll tell you right now, on the fill in the blank question, you can use abbreviations. You can put LLC, you don't need to write it out. And I'll give you full credit, that's fine. You don't need to worry about writing all that out. So LLC or GP, whatever, is fine. So that's first for the final, fill in the blank question, page 80. And we're going to go through those tonight, and I'll explain the differences between them so you'll have more information. Okay, the next thing, fill in the blank question-wise, is the next page over, page 81. And this is a list of 7 factors that you think about. Some of them are more important than others when you're deciding which of these organizational types you would want to utilize for your business. So we have limited liability. That is there any protection from a liability standpoint that's created by the business structure? What are the tax issues? And we're going to focus in this class on income tax, and really simply, is the entity, the business, subject to a corporate tax or not? We're not going to get into employment tax and payroll tax and statewide transit tax and Lane County metropolitan tax and all the different taxes you have. We're going to just keep it simple in this class and focus only on income tax, and I'll come back to that in a minute. The next factor, formalities, that is how do you form the business, what are the required documents and filing with the state and with the IRS and other government agencies. I'm not going to spend a lot of time on that in this class because that's a whole separate class here at Western. That's ENT 384.
Only 2?
What?
We choose
4. Yeah, list 4 factors. Okay, financing, management, the life of the business, and liquidity. I'm not going to get into a whole lot on those factors. Again, that's a different class. So the 2 that I'm really going to focus on are the first 2, limited liability issues and taxation. Those are the ones that I'm really going to focus on. But in terms of a fill in the blank question, what are 4 out of the 7 factors that you would analyze? All right, I'm going to come back to that page in a minute. So let's go over to page 82. So again on page 82, list 4 of the factors that you consider, and then list 4 of the 7 business organization types that we have. That's this top line here. So let me do this. List 4 up here, list 4 here. Okay? And then I'm going to want you to know, I'll lead up to it, but I'll explain it in more detail in a minute, which of these structures have liability protection and which ones do not, and which ones kind of have a blend. And then single tax or double tax right here. And I'll explain what all that means here in a minute. All right? So the rest of these boxes we're not going to really get into. All right, so let's begin at the top, and let's talk about the first factor that you analyze when you're deciding which of these structures you want to choose. So the first issue is liability protection. So when I talk about liability protection, what we're talking about is whether or not there is a shield that is created by the business structure that will help to shield claims against the owners of the business to shield their personal assets. Some of these business structures have no shield at all. So when I say unlimited, that means you have unlimited liability. If you're the owner of the business, you have liability where you could lose the business, but also if you don't have enough in the way of assets in the business, you could be personally liable, and your personal assets could be at risk as well. So there's no shield, and I'll explain that more in a minute. On the opposite end over here, we have limited liability, which means that there is a shield that is created by the business structure and will help provide some shielding of your personal assets in case there's a lawsuit or debt that cannot be paid. It's not 100% absolute, but we call that as much limited liability as you can absolutely get. So over here, sole proprietorship, general partnership, there's no protection whatsoever. And then over here, the 2 corporation types and an LLC, we have full limited liability. And in between, there's sort of a blend, and I'll explain that more in a minute. All right, so what am I talking about when I talk about unlimited liability? So let me just draw you a little picture here. And don't worry, I'm not going to make you diagram it out. So first, let's talk about not having any liability protection. So I'm going to use it as an example, a general partnership. A general partnership is essentially any time 2 or more people are engaging together to make money, and they're not otherwise organized as one of the other forms of business. A general partnership is created basically automatically whenever 2 or more people are working together to make money. It's a default. You default to a general partnership. So in a general partnership, I'm just going to say we have 2 partners, partner 1 and partner 2. And they're 50, we'll just say 50-50 partners. Okay? So what does that mean? As a general partnership, they share in the profits 50-50, and they have management authority. They get a vote on things 50-50, and they'll file a partnership tax return and all that. Now let's talk about liability issues. So let's say that this is a farm. All right, let's say a farm. So we have 2 partners that own the farm. So in the farm, let's say they have land, they have money in partnership farming checking account, the company bank account, they have equipment, they have inventory, they have insurance, and let's just say for purposes of this discussion that all combined, that's worth, let's just say $2 million. Okay, $2 million of business assets. So these are business assets. Each of them has a 50-50 ownership share. It's a $2 million farming operation. Now, up here, each partner, in addition to their business assets, they have their own personal assets, right? So each of them maybe has a house. Here's their house. personal checking account. They've got, sporting equipment and electronics. Maybe they've got retirement accounts, other assets that are their personal assets. So I'm just going to say, let's say this partner has $1 million net worth, and this partner has, let's say, $250,000 of personal, their house and all that. Business, personal. You guys with me? All right. So partnership, farming. So let's say one day we have an employee that's driving the tractor or the combine down the highway, going from one field to the next, and they don't notice a kid on a bicycle, and they run over the kid on the bike. Horrible, the kid's hurt or killed, and we're going to get sued now. So let's say there's a lawsuit, right? $5 million. Big lawsuit. So what's going to happen? They win $5 million in the lawsuit. The lawsuit's going to be against the partnership, which means it's going to be against partners. So they will go seize all of the assets of the business, $2 million, right? That's gone. That will be attached or garnished, sold at auction to help pay off that $5 million lawsuit. So here we go. So we still have $3 million that's owed. Well, now they're going to look for how to collect on that additional $3 million. There's no more business asset. So now what they're going to do is they're going to go after the general partners personally for their personal assets. And I should actually, let's say this guy's worth $11 million, right? $11 million. So they go after both partners. Both partners, even though they're 50-50, are 100% responsible individually for all of the actions of the partnership. This partner over here only has $250,000. That's gone. So they're going to go after this partner for everything else. And they're going to, maybe lose their house and their bank account and their inheritance or whatever other business assets they have outside of the partnership. In other words, there's no barrier here. There's no barrier between the business assets and the personal assets of the partners. So that's one problem, lawsuits. Now the other problem is debt. So if the partnership has more debt in terms of loans for the land and the equipment, and there's insufficient assets to pay that debt, then the lenders can go after the personal assets of the partners because there's no barrier. Another problem that you're concerned about is what happens if one partner does something bad. Maybe this partner's at lunch and they go out and eat lunch and they drink a pitcher of beer, they drive back to the farm, and they run over somebody in the company pickup. Well, they're going to get charged with driving under the influence and vehicular assault and probably go to jail. And there's also going to be a lawsuit against the partnership, this partner of course, but also against that partner. Because this partner did something wrong in the course and scope of the partnership, and there's no barrier. So when we're concerned about barriers, we're concerned about lawsuits against the partnership per se, but we're also concerned about creating at least some separation between the partners for if they do something wrong on their own. So that's why we look at having one of the other structures that doesn't have this problem. So, when I talk about unlimited liability right here, that means no barrier, all right? You have unlimited personal liability. There's no protection that's created by the business structure at all. So in a sole proprietorship is one person that is engaging in business activity on their own, one person. It's the default, meaning that's what you're automatically, unless you organize as one of the other structures. General partnership, 2 or more people, unless you're organized as one of the other ones. Okay, that's the default for 2 or more people. No liability protection whatsoever. Now, this orange line I have right here, that is the liability protection line. So everything on this side of the line, there's no protection, unlimited. personal liability. On this side of the line, you start to get into some or full liability protection. So now let me show you the opposite end, over here with corporations and LLCs. So now let's just say it's a LLC or a corporation, either an S or a C or an S corp, and I'll explain the difference in a few minutes. Either one, they're basically treated the same. Just the slight differences for liability purposes. So let's just say it's a corporation. So now we have, again, two shareholders. So shareholder number 1 and shareholder number 2. Same thing, let's say this shareholder is worth 11 million. Personal, this one's worth 250,000. And let's say they have $2 million of business assets. Again, it's a farm. All right, so same as what we just talked about a few minutes ago. So again, a lawsuit happens, $5 million lawsuit. So now they're going to go in, they're going to take all the business assets. Those are gone to help pay off that $5 million. Land, equipment, building, insurance, whatever there might be. So now they're still owed $3 million. So again, just like before, they're going to try to go after the owners to get that additional amount that's owed. But because it's a corporation or an LLC, there will be a barrier there, a shield, so that when they try to go after this shareholder, basically it bounces off, right? And so their personal assets are protected. They're protected. There's this barrier created. So essentially, they eat that $3 million. There's insufficient assets to cover it. So it's kind of like in Star Trek, right? Shields up, Scotty. That's what we're talking about, shield. It protects you from the incoming lasers and stuff. Now the other thing is, the shield goes this way as well. So that if one or the other does something, yes, you may lose your investment in the company. The value of the stock, if it's publicly traded, will go to zero, like Enron or WorldCom. Or if it's a closely held corporation, you may lose all of your investment in the company. But that's the extent of your risk. If one or the other does something wrong as well, yes, they may lose their share, but it's compartmentalized. So one shareholder is not going to have to pay the obligations of the other shareholder. Now, I will tell you right now, there are exceptions to this. I'm kind of highly simplifying things. Just kind of a real world, some of the different exceptions. Number 1, if the shareholders are not keeping adequate books and they're commingling assets, they're paying personal expenses out of the corporate checking account, they're not maintaining a real-life separation between personal and corporate, then a judge has the ability to bring down that barrier. It's called piercing the veil. And so that's why you have to maintain separate checking accounts, separate ownership interests, lease agreements. You have to have everything documented, and you have to keep up on it. Another time that this barrier would not exist is if one or the other shareholders or both of them signed what's called a personal guarantee. And that is where you agree that if there's a lawsuit against the corporation or there's insufficient ability to pay the debt, the shareholder guarantees that debt. It's kind of like a co-signer. And then you'll still be liable personally for that debt or that obligation. And that's really common in business, especially small business. Banks will require that. Landlords will require that kind of thing. Question?
Is that the same thing as self-insuring? Or?
No, self-insuring is when some law requires that you have insurance, like workers' comp, and you have sufficient asset base that the state will allow you to be self-insured, meaning the corporation doesn't have to carry workers' comp. Or another time you see self-insurance is in large trucking companies, where the feds require $1 million of insurance minimum. But if you have sufficient assets, you may not have to get insurance, but then you have to pay all of those bills. But to be self-insured, the corporation must have assets sufficient to cover any potential claims. And they have reserve requirements that have to be met. So it's slightly different. Yeah. All right, so one is if you're not maintaining separation. Two is if you sign as a shareholder that you'll guarantee the debt. The other time that this barrier can come down is if the owner was the one that did something wrong. So let's say this shareholder, the owner, was the one that was driving the tractor and ran over the kid on the bicycle. Well, they're still going to get sued individually because they were the driver, right? You can't hide behind your corporate shield when you're the one that did something wrong. If it's an employee, that's different. But if it's you, as the driver, you can be sued personally along with the corporation. Now, this shareholder is still shielded. That's why we have this barrier here. But this shareholder will be personally liable because they're the one that was driving. Again, you see that a lot in trucking, where you have, it's called an owner-operator that's operating their own semi-truck. They're the driver, and they're the one that ran over somebody. So they're still going to get personally sued for that. Now, again, there are a lot of exceptions to that. For this level of class, all I really want you to know, okay? Real simple, we're going to keep it simple. No liability protection, liability protection, right, with some exceptions. Now in the middle here, it's a bit of a blend, and I'll show you what I mean by that later on, because it gets kind of detailed. But all I want you to know, real simple, no liability protection at least at some level, okay? If you know that much, that's sufficient for this class. So I might ask you this question, okay? True or false, a general partnership creates liability protection for the owners. False, no liability protection. True or false, a corporation provides liability protection for the owners. That would be true, okay? Or I might ask you, multiple choice question, which of the following does not have liability protection at all? Answer, S Corp, C Corp, LLC, or sole proprietorship. The answer then would be sole proprietorship, right? So that's kind of the level of question that I would ask you. You want to know more than that? You're talking law school, there's other classes. Now, with that said, real world. Yes, you may be an LLC or a corporation, but in the real world, your first layer of protection is insurance, liability insurance. And that will depend on what you're doing. So either premises liability for your building, professional liability if you're like a doctor or lawyer or whatever, where you professional malpractice, general lines policy liability insurance, that's for general claims arising out of your business. There's all kinds of insurance. That's your first line of defense. So just because, and I've had this question from clients, just because you set yourself up as a corporation doesn't mean you don't need insurance, right? That's your first line of defense. If you get sued, you want to have insurance in place because one, they'll hire you a lawyer to defend you, and then two, they'll pay up to the limits of the policy if you're found liable, or they'll settle the case. So your first line of defense, yes, set up as a corporation or an LLC, and then buy insurance. Okay, so that's the first liability. That's what I mean by that. Now the second issue that we're going to analyze is tax. And if you look here on all these boxes, single, 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 single tax, double tax, single tax. In fact, I think what I'm going to do is I'll put some green, get some pretty colors. Double tax. There's only one on this list that has double tax, and that's C Corporation. And for this class, we're going to leave it that way. In the real world, there's others, but I don't want to confuse you because it gets really technical. So for this class, all of the business structures other than a C Corp are what we call a pass-through, single level tax. Now, I want to show you a term real quick. Page 81. Pass-through entity. Pass-through tax. This is a term that is used in accounting and tax law to refer to the type of business structure where the profits flow through the business down to the owners. The business itself does not pay tax on its profits. The owners will pay tax on the profits at their individual level. So we call it pass-through. Pass-through entity. Now again, we're talking about income tax. Tax on your net income, taxable income, right? So I'll show you how that works here in just a second. I'll do it right now. So pass-through entity. So I'm going to start with a non-pass-through, which is a C corporation, right here. Okay, C corp, double tax, corporate tax and individual tax. Now again, we're talking about income. So C corp. Okay. So now let's say again it's a farm and farming corporation. And so now instead of having two owners, I'm going to say we only have one, just to keep things simple. So here's our farmer, right? Let me ask you this question. Is it legal to have a one-person corporation? Actually, it is. In the United States, at least. Other countries, it's not. In the U.S., you only need one shareholder. So I'm just going to say we have one shareholder, operates a farm. So let's say that the corporation, and again, don't worry, I'm not going to make you diagram this out, all right? Just want you to illustrate how this is going. So gross income, let's say $1 million for the year. So the gross income, $1 million from selling grass seed or livestock or whatever, right? Expenses for the year, $900,000. So that leaves net $100,000 after expense. So in other words, net profit $100,000. So now the way that this will work, the C corporation is a taxable entity. What that means is March 15th, which is coming up quick here, for a calendar year taxpayer that is. On March 15th, the C corporation will have to file an income tax return with both the Internal Revenue Service, the IRS, and the Oregon Department of Revenue, ODOR, or ODA, right? And so that return is called an 1120 form. You don't need to know that. I will not test you on that. Don't worry about it. But just so you kind of have a basic understanding. So on March 15th, they'll file an 1120 form. And on that form, they will report $1 million of income, $900,000 of expense, $100,000 of net or taxable income. So the corporation then will have to pay corporate tax, and I'm just going to round it off and say it's 35% combined federal state. And so that's going to be $35,000 in tax. Okay? So that leaves $65,000 of cash after the corporation has paid corporate tax, the first layer of tax, right? So now, we have one shareholder. So that money is distributed down to the shareholder, and we call that a dividend. And the shareholder then, on April 15th, when they file their 1040 form, and again, don't worry about the form numbers, I won't test you on those. On April 15th, the shareholder here is going to have to report all of that $65,000 that they received as a dividend on their individual tax return, and then they will have to pay tax on that themselves at their individual rate. And to keep the math easy, I'm going to say it's a 20% combined rate. It'll actually be higher than that. So they're now going to pay, what's that work out to? $13,000 in tax at the individual rate, okay? So the money that they receive as a dividend from the C Corp, they pay tax at their individual level. The corporation paid tax at a corporate level, individual pay tax at the individual level. So that's why we say there's a double tax on my little chart. Right here, the double tax. Tax at the business level, tax at the individual ownership level on the money that they receive, right? Now again, don't worry, I'm not going to diagram this out. Literally, all I want you to know, real simple, C Corp, double tax. The rest of them, single tax. So if I'm getting way beyond you here, don't worry about it. Now let's talk about the rest of them. Now I'm going to highly generalize here because partnerships and S Corps and LLCs are a little bit slightly different in how things are done. So I'm just going to lump them all together as just a single tax. So I'm just going to use, for example, an S Corp. And I'll explain what I mean by that more in detail in a few minutes. But an S Corp is a pass-through entity. Now, what I mean by that, again, same example as before. We got one farmer, that is the shareholder. It's a farm. And again, same as before, 1 million of gross revenue, 900,000 of expense. So we now have 100,000 of net income. All right? Same as before. But now, here's the difference. Again, March 15th, S Corporation has to file an 1120S form. Again, don't worry, I won't test you on that, but just so you understand. So March 15th, which is coming up, if you haven't filed an extension under S Corp, you need to do that, or your LLC. Filed mine already. So now what's going to happen, on March 15th, the corporation will file a tax return and report $1 million of income, 900 of expense, 100,000 net to the IRS and to the Oregon Department of Revenue. But it is what's called an information return. So there's not going to be any tax here. This $100,000 passes through down to the shareholder. That's why we call it a pass-through. It drops down to the shareholder. You file this tax return to report it. That way the IRS knows, okay, this shareholder better be reporting $100,000 on their individual return in April, a month later, when they file their 1040 form. And just so you know, this is reported on what's called a K1, which is a report of income. So, now the taxpayer will report the $100,000. They're going to have to pay tax on that, so I'm going to say 35% tax rate, combined federal state, so $35,000 in tax. Okay? See the difference? There's no tax here at this level. It passes through down to the owner. That's the difference. So let me show you again. C Corp, double tax. Tax at the business level, and again, when it gets down to the owner, they pay tax at their individual level. Here, no tax at the business level. You still report it, but it all passes through down to the owner. Or if you have multiple owners, they would split that all up based on their percentage. That's why we call it a pass-through, all right? Pass-through entity. So, pass-through, 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 pass-through. Non-pass-through, C Corp, LLC, for the most part, is going to be a pass-through, right? So single tax. That's what I mean by single tax. All I want you to know, keeping it simple. Double tax, C Corp, single tax, all the rest of it. If you know that much, you're good. Okay? Now, real world, this does not include Social Security, Medicare, Medicaid tax, which combined employer-employee is 15.3%. Doesn't include unemployment insurance tax, which may be anywhere from 1% up to 3.5%. Doesn't include workers' comp, transit tax, workers' comp benefit fund, Wayne County Transit District, Multnomah County Transit District, and all the other taxes, okay? I'm highly simplifying. All I'm talking about is corporate, that is business level income tax. So those other taxes, that's 2 or 3 different classes beyond the scope of this course. All right. So with that said, let's move on and kind of look at the different structures on how they're structured so you kind of understand the differences on how they're set up. For the test, focus on these 2. So the kind of questions I'll ask would be, okay, which of the following business structures is subject to a double tax? Sole proprietorship, limited partnership, limited liability partnership, or a C Corp? Answer, C Corp. All right, simple, keep it simple. I'm not going to make you diagram, you don't need to worry about the tax form numbers, none of that. All right? Just keep it simple. So with that said, let's move on and start talking about the differences in how they're structured. So first of all, sole proprietorship, general partnership. I'm not going to spend a lot of time on them because they're pretty basic. Sole proprietorship, whenever you do anything to engage in business, you're automatically considered a sole proprietorship. Unless you organize as one of these other structures, you're a sole proprietor. Just you. By definition, one person only. Can't have 2 or more people and be a sole proprietorship. So if on the test I ask you, Bill and Ted want to form a business together, sole proprietorship is going to be wrong, no matter what. Why? There's 2 of them, right? Okay. Single tax. Now, formality. When I talk about formality, what I'm referring to is what paper do you have to file in order to legally set up your business and keep it operating legally. Now when I say file, state of Oregon, or whatever state you're doing business in, federally with Internal Revenue Service, or other agencies at the federal level. So typically speaking, the more liability protection, the more formality there is. In addition to that, the more ability to get investor income, like publicly traded, so you're selling stock on the stock exchange, the more formality it is. The more ability you have to raise money in the public, a lot more formality. Highly, a lot of formality if you're going to be publicly traded, subject to security exchange rules. As opposed to a sole proprietorship, there literally is none. You automatically are a sole proprietor when you start doing business. Now, with that said, if you're going to do business in other than your legal name, or some derivative of your name, like Hasbrook's Hot Dogs, right? If I'm going to do business as Hasbrook Hot Dogs, as a sole proprietorship, I can just go do so. But if I'm going to use some other name, like Monmouth Super Good Hot Dogs, or something, then I'm going to have to file with the state for what's called an assumed business name, an ABN. This is sometimes referred to, you'll see this sometimes called a DBA. You may have heard that before, doing business as. So basically here's the idea. If you're using your name as your business, you're good to go. But if you're going to have a different name, that has to be registered so that we can go look up to see who is responsible for Monmouth Super Good Hot Dogs. So, assume business name. General partnership, same thing. General partnership is created automatically whenever 2 or more people are engaged in activity together to make money. And again, if it's just you and your partner using your names, then you don't really need to register that. But if you're doing business in a different name, like a company name, then you need to register the assumed business name to the general partnership. And I'll explain that more in a minute. So for example, if we have Scrooge and Marley bookkeeping, right? General partnership. Don't really need to register that, it's a general partnership, you've got their names there, we can go look that up. But if they want to have 3 Ghosts bookkeeping, then they're going to have to register that back to Scrooge and Marley as the partners and put the names of the partners in. So when I say file with whom, where? And that's what I have right here, SS. Secretary of State. I'll show you something on page 81. Formalities. File with the Secretary of State. I do want you to know that. I'm not going to get into all the different forms, SS4 and 255, don't worry about any of that, okay? You don't need to know this stuff for this class. It's a different class. I use these same materials in some of my other classes, that's why they're so detailed. But I do want you to know this. You may have to start a business, the first place you go is you file with the Secretary of State's office. And you will file, depending on the type of business, if it's like an LLC, articles of organization. If it's a corporation, articles of incorporation. If it's a partnership, it'll be a partnership certificate. And I do have those forms in my book here if you want to look and see what they look like. Nowadays we file that online, electronically, for the most part. I'm not going to go through all those forms. That's a totally different class. It's an entrepreneurship class. But I just want you to have a general understanding that's what you do. So the Secretary of State is the state agency in every state that regulates business. And that's where you file to start your business. And every year you have to renew it to keep it current. All right. So, sole proprietorship, general partnership. Super simple, automatically the default. You're deemed to be a general partnership automatically when you're doing business with somebody else, and you don't organize as one of these others. Now there's another little thing I want you to know about a default. Let's say you want to be a limited partnership or a limited liability partnership, but you don't file your paperwork correctly, or you don't renew. You will then default to being a general partnership. You default back. So what does that mean? That means that you might lose your liability protection. So you got to be careful. Make sure you keep yourself current, that you comply with all the rules to form your business to begin with. That's kind of like that shield coming down I was talking about earlier. You don't keep things current, you default back, you lose your liability protection. All right. So enough on those two. They're pretty straightforward. By the way, just so you know, if you want more information in my book here, I've gone through all of these and given you a lot more detail. You don't have to read all this. I use this again in other classes, so it's way more detailed than I'll test you on, but I do have it in there. I also have the forms I was talking about. Like here's the assumed business name form that you would file with the Secretary of State. If you wanted to start a corporation, this is the form that you would file. Won't test you on any of that. Totally different class. But I put it in there just for your own personal knowledge. All right, so now let's start talking about these other structures and how they're different from each other. So, first we have limited partnership. The idea behind a limited partnership is to essentially, in a nutshell, allow for investors to buy in and to get a return on their investment. But they don't want to have, the investor does not want to have liability other than the amount that they've invested. They want protection in case the business folds, there's a lawsuit, too much debt, or whatever. They're willing to risk their investment, but that's it. That's all the risk they want. And so the idea of a limited partnership is a form of business structure that allows for investors to put money in and have a shield that protects them in case there's a lawsuit. Very old form of structure. I mean, literally goes back to ancient Rome, the Byzantine Empire, the Greek Empire. This actually started a lot with shipping in maritime law, where you had a ship captain that would go get investors for a voyage. They would buy a ship and crew it and put cargo in, and it would be a form of a limited partnership. Very old form of business. Goes by different names depending where you're at. So, I like to call a limited partnership, just to make it kind of simple to think about, and you've probably heard this term before, a silent partnership. Have you ever heard that term before? Silent partnership? And the reason why we say a silent partnership is that the idea is the limited partners will be given liability protection, right here, but they give up their ability to engage in day-to-day management, down here. Instead, the general partner, there'll be a general partner that will be the manager. They're in charge of things. They make all the decisions. They pay the bills. They buy things. They sell things. They decide pricing and all that. So they're managing. The limited partners are only investors. So they have to give up their ability to manage, but in exchange, they get limited liability. So let me diagram that for you. Again, that's why I like to say silent partnership. The limited partners are silent. They can't be engaged in management. So let's say we're going to have a limited partnership. An apartment building, like student housing, right? $3 million building. So the idea is the limited partnership is going to buy this building, rent out the apartments, collect the income, pay the expenses, and whatever's left over is going to be distributed out to the partners. So let's say we have 3 limited partners that are the investors. Limited partner 1, limited partner 2, limited partner 3. They each put in $1 million to buy this building. Okay? So they've now made $1 million investment each to buy the $3 million building. In exchange, they're going to get a 30% limited partnership share. Right? I know that doesn't total up to 100. I'll show you why in a minute. So, $1 million each. They put it into the partnership. They buy the building. The building is now owned by the partnership. So they're going to get a 30%, every month of whatever the net income is from all the rent that comes in, less the expenses. So they're investors. As investors, they will therefore have a liability shield. Actually, I'm going to put it up here. A liability shield. The money that they put in is at risk. So if they get sued, they could lose their $1 million that they put in. But that's the extent of their liability. So there's a shield there. There's also a shield this way that isolates them from each other. Now, we need somebody to manage the business. So like, here's the manager's office down here in the apartment. So we will have a general partner that's going to be the manager. They're going to live in this apartment. And we're going to give them that apartment to live in free, rent-free. We're also going to give the general partner, let's say, a 10% share. They may or may not have made any investment. In this example, let's say they made no investment in the initial purchase. All they're doing is managing. We're going to give them 10% as a manager fee, plus they're going to live in an apartment rent-free. So that's their compensation. So the general partner will be in charge of all of the management. They're going to decide who to have as a tenant, what color carpet to put in, whether or not to put a new roof on, all of the kind of stuff. They're going to pay all the bills, collect all the rental income, sign checks, do all the tax filings, all that stuff. So, the general partner has management authority, but along with that, the general partner has liability. And the idea is if you're in charge, you're responsible for the decisions that you make. So let's say, for example, the general partner doesn't notice that, this is a deck. And the general partner doesn't notice that the deck's all rotted out right here. So somebody's out here on the deck, and it breaks, and they fall down. They get hurt, and we get sued for $5 million because they're now horribly injured. Awful. So, what happens? Just like I showed you before, $5 million lawsuit. They're going to go take the apartment building. That's going to get sold at a sheriff's auction. Bye-bye, it's gone. $2 million is still owed. So now, they're going to go after limited partners, but what happens? Bounces off. Bounces off that shield. So they still can go after the general partner because the general partner has unlimited liability. But the general partner probably doesn't have much in the way of assets, so they just bankrupt out. All right. So here's what I want you to know about a limited partnership. Again, I'm not going to make you diagram anything. Right here, liability, unlimited for the manager, the general partner. Limited for the investors, limited to the amount of their investment, the value of their investment. Down here, under management, general partnership, all partners can manage by their percentages. Limited partnership, it's different. You have a manager who's the general partner, or it might be more than one person, might be a group. And you have limited partners, and their job is not to manage, but they simply get a return on their investment. So that's why we say general partners manage, the limited partners cannot engage in management. All right, so silent partnership. The reason why we call it silent is these partners have to remain silent. Their only real management ability is to vote on who to be the general partner. Now, here's something to be aware of. If one of the limited partners or more of them, they're not supposed to engage in management, but in the real world, they usually do, a lot of times, especially in small business, like when we only got 4 people here. So let's say limited partner number 1 is actually doing a lot of the management. They're writing checks, they're paying bills, they're deciding which tenants to have, they're doing repair work on the building, all that kind of stuff. So now we get the lawsuit. Again, they're going to try to go after the limited partner. Limited partners will say, no, there's a barrier there. But if it can be shown that the limited partner was actually engaged in management, that barrier may go away. It's brought down. And they become, in effect, a general partner. So their personal assets are now at risk. So that's why you've got to be careful about in the limited partnership form of business. All right, so that's why we call it silent partnership. Okay. All right, next we have limited liability partnerships, LLPs. So, LLP. So the idea behind an LLP, it's a newer form of business structure. I don't know exactly how old. Never actually looked that up, but they're pretty common. The idea behind them was to put together a form of business organization that primarily would allow for service providers to work together in an office or a practice to help split the overhead, but to limit the liability that they would have in case the other professionals engaged in malpractice. So I'm going to use an example of a medical clinic. So now instead of an apartment building, this will be a medical clinic. So let's say we have 3 doctors, doctor number 1, doctor number 2, and of course we have Dr. Evil. Got to have Dr. Evil in there somewhere. So we have 3 doctors. So these 3 doctors want to start a medical clinic. So the medical clinic, again, let's say it's going to cost $3 million to buy the clinic and put all the equipment in there and all that kind of stuff. So they buy the clinic, they each put in $1 million, and they're a 1/3 partner in the clinic. Now what that means is, the idea again, they don't want to operate their own clinic on their own and have all that overhead expense to buy the building and all that. It's not cost effective. They want to be able to split their caseloads. They can go on vacation once in a while. They want to split the employee costs and all that. So the idea is to allow them to work together to operate a clinic, where this could be doctors or dentists or lawyers, insurance agents, financial planners, stockbrokers, real estate, architects, engineers, veterinary doctors, veterinary clinic. You kind of get the idea. We're talking service providers, okay? So for purposes of the joint operation of the clinic, they will be considered general partners. What does that mean? That means that they each get a vote. 2 out of 3 controls. They get management authority, because general partners have management authority. They will split any profit that arrives out of the clinic, or if they sell that building in the future, 1/3 each. It's a pass-through, so they pay tax at their own individual level. But the problem is, they have unlimited liability, because they're a general partner for the clinic. Well, yeah, that's not great, but you know what, that's at least manageable. I mean, the main thing you're worried about, like with a doctor, or a dentist, or a lawyer, or an architect, or an engineer, or whatever, what if Dr. Evil gets sued for all the weird things that Dr. Evil's doing? Malpractice. Maybe Dr. Evil doesn't prescribe medicine correctly, or misdiagnoses somebody, or messes up in surgery, malpractice. So for malpractice, that is professional liability, they will be considered limited partners. What does that mean? That means that there's a liability shield. So basically, they're protected from each other. So if Dr. Evil does something wrong, so long as the other 2 doctors were not part of that diagnosis or the surgery or whatever, they're shielded from Dr. Evil if Dr. Evil gets sued, and vice versa. So, back to my little chart, under liability. Whoa, come back here, there you go. Unlimited liability for general obligations, that is the clinic. Limited liability for the individual actions of each of the separate partners. That's the idea. General partner, full liability, unlimited, but you have limited liability for individual partners' activities. Now down here, under management, they all get a manage in that model. Or sometimes you would have a management committee or something. So like if your law firm, maybe you had, I don't know, 100 lawyers in the law firm, or the medical clinic, or whatever. So we have a management committee of 3, the managing partners, and all the others are just going to be limited partners. So that just depends on how you structure it, and that will be written out in what's called a partnership agreement. All right, so what's the difference between these two? In a limited liability partnership, you do get some management authority, right? But then you're considered a general partner. In this one, you have 2 separate roles: partnership roles, limited partner roles, and general partner roles. They're separate from each other. All right, let me ask you this question now. Which form of partnership has 100% liability protection for everybody involved? Trick question. None of them, right? Unlimited, unlimited, unlimited. So no form of partnership has full limited liability protection. Let me repeat that. No form of partnership has full 100% liability protection for everybody. That's one of the disadvantages of the partnership model for business, and that will meet, when I get to LLCs here in a minute, that's partly why we have LLCs. All right, so now, another little thing. So let's go back to 1985, 1984 actually. So before we had S corporations and LLCs, they're both fairly new. S corporations have been around since '86, if I remember correctly, 1986. So before then, and LLCs are the mid-1990s, so they're fairly new. So before then, 1980, let's say you were one person. You're a farmer, and you wanted to have liability protection. Full liability protection. What were your options? One person as a farmer. You had 2 options. What were they? Sole proprietor or a C Corp. So if you wanted to have liability protection, you could not be a sole proprietor, right? And most farmers, they don't want to be, they want to have liability protection for all, employee action, all that kind of stuff. So what was the problem? One person, you had to be a C Corp. What's the problem with being a C Corp? Is one person. Double tax, right? So if you want liability protection, you got to pay double tax. So that's a huge impediment to small business, family-run businesses. Same thing, let's say we have a group of siblings that inherited a farm, maybe 4 of them, and they all want to have management authority, but they don't want, they want limited liability. Well, can't be a general partnership because you don't have any liability protection. Can't be a limited partnership because then one of them has to be the limited partner or the general partner and the others can't do anything. Can't really be a limited liability because operating a farm wouldn't be individual malpractice, it's general. So you had to be a C Corp. So a family-run business, same thing. If you want limited liability, you got to be a C Corp. So again, that was a real problem with small business and that kind of thing. So that's where S corporations came from. The idea behind an S corporation in 1986, mid-80s, was to allow for the limited liability protection of a C Corp, but the single tax benefit of sole proprietorship or a partnership form. So no double tax, a pass-through. And that's the purpose behind the S Corp. That's why they were created. So an S Corp is a small corporation. That's not really what S stands for. It stands for subchapter S of the Internal Revenue Corporate Tax Code. This is chapter C. But in the real world, that's what an S Corp is. It's intended to be a small business form of structure. C Corp can be one person or it could be 100 million shareholders. Like, no idea how much stock, how many shareholders in Apple or Intel or whatever, there's a lot, right? S Corp, not going to be that way. So first of all, let me show you the basic structure of a corporation and diagram it out for you. And this will be true for both S Corps and C Corps. Okay, so basic structure. So the owners are called shareholders. So let's say we have 2 owners, shareholder 1 and shareholder 2. And just like in the other situations, they put money in and they get shares of stock back, which is an ownership interest in the company. Now I'm saying money, but it could be other assets, it could be equipment, it could be patents, it could be trademarks, it could be labor, whatever. In other words, you put something in, you get shares of stock back. That's why I call them a shareholder. So the percentage of shares, their percentage of ownership will depend on the number of shares they have. So if one has 50 shares and the other has 25, then there would be 75-25% differential. 50-50, just depends on the number of shares. All right. Now the shareholders in and of themselves don't really have specific management authority. There is a liability shield that's created that will protect them in the event of a lawsuit or a debt. On the management side, down here, we have at the first level of management is the board of directors. The shareholders will vote each year to appoint the people that will be on the board of directors. Board of directors are not necessarily the day-to-day operations, they're more general policy. The day-to-day will be the officers, and that's usually going to be in a small business, a president, a vice president, a secretary, and a treasurer. Although sometimes you'll see 2 layers of officers. You might see a CEO, CFO, CTO, CLO, COO, Chief Executive Officer, Chief Financial Officer, Chief Technology Officer, Chief Legal Officer, Chief Operating, whatever. Okay, so you might have 2 layers, but they'll be appointed by the Board of Directors as well. And then from there, you will have the employees and agents. So this is kind of the typical corporate structure. Shareholders are the owners. They vote on the board of directors. The board of directors will appoint the officers, and then the officers will do the day-to-day along with the employees. That's a typical structure. Now, how that structure will all depend on how you write the bylaws up of the corporation, which we won't really go into here. So let's talk about the differences between the two. So page 84. Okay, so again, the idea behind S-Corps was to create a business structure that would promote small business and family-run business. Keep that in the back of your mind. So the advantage of an S-Corp is single tax. There's no corporate level tax. You don't have that double tax problem. Single tax, double tax. Now the trade-off is an S-corporation has to remain small. So you're going to limit the number of owners. So it's limited to 100 shareholders. So they're not going to be publicly traded if you're an S-corp. C-corp, literally an unlimited number of shareholders. In addition to that, an S-corp, you have to have only one type of stock. That is what we call common stock. In a C-corp, you can have different types of stock. You can have common stock, Class A, Class B. You can have preferred, you have preferred plus that guarantees a percentage. You could have convertible, which means you can convert it to debt, or debt convertible to stock. You could have, like Berkshire Hathaway, Class A shares and Class B shares. Voting preferred, non-voting preferred. I mean, you can have all kinds of different classifications. S-corp can't do that. You have to treat everybody the same. They all have to be one type, one form of share of stock. And in an S-corp, there's limitations on who can be a shareholder. Now, this is not the only limitation, but this is the main one. Shareholders have to be human. What does that mean? So how can you have a non-human shareholder? A cyborg? A dog? Like a pet trust? Yeah. I mean, you can actually set up trusts for dogs and cats, and like, who's the guy that just had the designer? Versace? Lagerfield, right?
Why he's doing this?
He gave like $20 million to his cat, right?
It has to be like a personnel, like a LLC or something.
Right, exactly. Okay, so primarily what I'm getting at there is the shareholder has to be a human entity, not another C-corp. So a C-corp cannot own an S-corp. Or an LLC as a separate entity can't own an S-corp. Or a trust, except for some exceptions called a qualified subchapter S. A pension plan, profit sharing plan, nonprofit, union, charitable organization, that kind of thing. So with some exceptions. So that's what I mean by that. C-corp, no problem. Other corporations can own C-corps, pension plans, unions, all that stuff, right? Government entities can own shares. So you get the idea. So the main two I want you guys to know, all right, double tax, single tax. We've been over that already. Unlimited number of shareholders, limited number of shareholders. Those are the two main ones. I won't really get into the different kinds of stock. I will also tell you there's some other differences which change all the time, having to do with the deductibility of like healthcare benefits, pension profit sharing plans, things like that, which I won't really go into here because it gets too complex. So, small corporation, S-corp, potentially big corporation. And I say potentially because you can have one person or two people as a C-corp. It's not always going to be a big company. All right. And then that brings us to LLCs. Okay. So LLCs are the most recent form of business structure. LLC stands for Limited Liability Company. And basically 1990s, is when we started seeing them. The idea behind an LLC is basically to allow for the maximum amount of flexibility. So kind of, I sort of make a comparison, like an LLC is a bit like molding clay, that you can mold it into whatever you want it to look like. I can make it look like a boat, or an airplane, or an elephant, or a table, whatever. I can model it into whatever I want. So another way of looking at it's kind of like, all right, I can pick and choose which of these structures I like from the various different ones. I like the single tax over here, I like the management authority here, but I want the limited liability of a corporation here. You know, I want management agreements. I can kind of pick and choose which, and sometimes more than one of these different boxes I like, and mold it into whatever I want it to be. It's basically whatever you want. So it's very, very flexible, which is both good and bad. The good thing is that you can create it however you want. Bad thing is, because it's so flexible, that can lead to confusion and disputes. And it's really important that you have it organized and paperwork in place so everybody knows what's going on. So from my mind, in my standpoint, I break LLCs down into 4 basic variations, okay? So here we have LLC. So the owners in an LLC are called members. So you're a member of an LLC. Again, like everything else, you put money in and you get a percentage back of ownership. So the owners are called members. So now an LLC is very flexible, but they, in my mind, like I said, I break them down into 4 variations, more or less. So the first variation is that of a sole proprietorship. The second is that of a general partnership. The third is that of a limited partnership. And then finally we have the corporate variation. So, sole proprietorship variation. What's the advantage of a sole proprietorship? It's simple. You don't really have to do a whole lot to set it up. One level of